Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking consumer discretionary stocks and my guest is Keith Gangl, Portfolio Manager at Gradient Investments. Eat a McDonald's, buy a Tesla, go on an ocean cruise. Consumer discretionary is a diverse sector of retail, leisure, restaurants, autos and more, serving the whims of American consumers. And just like those consumers, it has been battered by inflation and an unsteady economy. But could that be changing? Moderating price pressures and hopes for an end to aggressive rate hikes argue that yes, it could, though not gone yet is the fear of a recession that has dogged consumer sentiment. Performance-wise, S&P 500 consumer discretionary has underperformed the wider market over the past 5 years and has lost close to 20% over the past year, but it has seen a very strong surge in January of around 15%. This $3.8 trillion sector is dominated by three players, Amazon, Tesla and Home Depot, which make up around 45% of the index as they do the SPDR Consumer Discretionary Select Sector Fund. Specialty retail and internet and direct marketing retail are the biggest subsectors. So should consumer discretionary stocks be an investor staple? Joining me now to discuss that is Keith Gangl, Portfolio Manager at Gradient Investments. Keith, great to see you. US retail sales showed their biggest drop in a year in December. Inflation and interest rates are still high, and there is the whiff of recession in the air. Why should we invest in consumer discretionary when Americans are still pinching their pennies?
A lot of the problems you just talked about earlier was high inflation. People worry about the economy slowing. What's the Federal Reserve going to do? They're going to increase interest rates. How does that impact their wallets? Consumers are drawing down their savings, but now we think it's a time to actually jump back into these names. Stock market is forward-looking, so we think we've seen the peak in inflation rates. We've seen the Federal Reserve coming towards the end of raising interest rates. That should be an all-clear sign for the consumer. So we like these names as we're coming to the end of the Fed hiking cycle. Again, like I said, inflation's easing. Unemployment's still really low. We're at 3.5%. That's a 50-year low. So people are still working, getting paychecks, and the U.S. consumers like to spend money. So as long as they have a job, they'll continue to spend it. And that's why we think consumers are set up very well for this year.
Now, 4 sectors up close. You've picked some names you like. Let's start with one of the biggest, which is Target. It's down 22% or thereabouts on a one-year basis and has had problems with a backlog of inventory. But is that now improving?
The problem is with the COVID, they gained market share, so they ordered too much inventory. And so when the economy started to slow down, people started to, like you said, pinch their pennies. They started to do a little less shopping. So Target had to clear their inventory. And how they do that is price discounting. So their margins have gone from 8% down to 3%. But we think now the last couple of quarters, they've cleared all that inventory out. And so now they can focus on their main business. They continue to maintain the market share that they gained over the COVID shutdown. So for patient long-term investors, we think there's a great opportunity to buy a stock that's trading in the low teens.
Now, one company that surprised recently with relatively strong Christmas sales and which has a very strong growth rate is the specialty discounter Five Below. Tell us your thoughts there.
Yeah, Five Below we like a lot. This is a little bit of higher multiple, but they've done fantastic sales. They recently pre-announced their sales in the beginning of January at about 11%. That's fantastic. Where other retailers are doing, 2-3%, they're doing 11. They've actually moved that price point up as well. So they're increasing their technology sales at the company so they can get higher price points. They're breaking that $5 mark, which is good. So that's good for their margins. There's 1,200 stores. We think they can grow to about 3,500 over the course of several years. So they're growing square footage by 10+%. There's not another retailer that's doing that in that category.
So let's move on to a couple of other specialty retailers, O'Reilly Automotive and sportswear retailer Lululemon. Now, Americans love cars, of course, and O'Reilly is up around 26% on the past year. But do they still love exercise as much as they did during the pandemic?
A great question. So O'Reilly's a little bit different story than the other two names. That was actually an outperformer last year. As gas prices come down, we think they can continue to execute. Their multiple is in the mid-20s, but they're growing their growth rate at about high teens. Now, you touched on a different one, a little bit different, is Lululemon. They're by far the brand leader in apparel. Apparel in general has been tough. A lot of people are clearing out their inventory. Even Lululemon, with their high brand, high recognition, they're starting to have to discount a little bit, which they haven't done before. So their margins are coming down a little bit. So investors are a little bit spooked here. But we think this is a good opportunity to buy a high quality, high brand, high growth retailer at a discount to its normal valuation.
And finally, how are patterns evolving in US discretionary retail? For example, are Americans becoming more interested in services and experience rather than just getting more stuff?
We've seen some really good numbers out of service. We've seen travel and leisure, that's picking up. That's another space that generally we like in the consumer space as well. People are going back out to eat, having a good time. They're spending a little less on goods that they can own, and they want the more of the experience at this time. So we like those kind of names, and we have plenty that play into that space as well.
Keith, it's been fascinating to hear those thoughts. Keith Gangl, Portfolio Manager at Gradient Investments, thank you for being with us today. And that is your roundup of the consumer discretionary sector. I'm David Pollard. This is Reuters.